Here is why the Fed's warnings about market fragility matter right now. In 2025, Federal Reserve Chair Jerome Powell signaled a looming shift in monetary policy, a cautionary note echoed by historical patterns suggesting a 2026 reckoning. Today's markets reflect this tension. Gold surges past $4,532, driven by safe haven demand, while the S&P 500 holds firm at $6,934, hinting at resilience. But beneath the surface, cracks are forming. Powell's remarks weren't mere rhetoric. They mirrored 2018's pre-crisis signals, where tightening liquidity and inverted yield curve preceded the 2020 crash. Today's parallels? A yield curve flattening, corporate debt burdens rising, and retail inflows skewing asset allocation. Institutions like BlackRock are already recalibrating portfolios, shifting toward defensive sectors and cash reserves. Geopolitical volatility amplifies this risk. Energy prices fluctuate amid OPEC+ tensions, while China's growth slowdown pressures global supply chains. Meanwhile, the Fed faces a dilemma: sustain ultra-low rates to fuel growth or tighten aggressively to curb inflation, a decision with cascading implications for bond yields, equity valuations, and currency flows. Inflation remains the silent driver. Despite recent cooling, core CPI persists above 3%, eroding real returns on fixed-income assets. This explains gold's rally. Precious metals act as insurance against purchasing power erosion. Yet, the S&P's modest gains suggest investors remain optimistic, balancing risk-on sentiment with cautious positioning. For traders, the message is clear: prepare for a pivot. Short-term volatility could amplify as the Fed navigates its dual mandate. Position defensively in commodities and high-yield bonds, while monitoring Treasury yields for clues on rate trajectory. At Qanexra, we're adjusting Raymond swing levels to account for heightened uncertainty, prioritizing liquidity over leverage. If this analysis was valuable, subscribe for more institutional insights. Link in bio.